Okay, very good morning. It's Monday the 8th of January. Good to be back. Happy New Year to everyone if we haven't caught up with you formally as yet. I hope you had a nice break. But just looking at the markets and really catching up on last week and over the weekend, the news flow and so on. And you really haven't missed a lot in terms of key themes because it's been very much a continuation of a lot of the things that were driving financial markets towards the end of last year, namely being this kind of surge in equity markets. The Dow, as you might have seen at the end of last week, breached a significant level. If I just bring it into shot here, we kind of spent much of the end of, or the run into the Christmas season as liquidity started to dry out in towards the final week, if you like, into the festive period. But then we broke that pretty much soon as we came back last week. And irrespective of a non-farm payrolls report, which, if you weren't watching the markets, came out last Friday, was a little bit soft, i.e. The average hourly earnings was pretty much on track, in line, but the headline jobs creation was a little weak at 148 against 190, but it did receive an upward revision to the previous. So it wasn't the best jobs report, but it wasn't bad enough to detract from the general global sentiment, which is still one driven by optimism going into global growth conditions for the beginning of 2018 at least. So here we are looking at the Dow here. We've jumped 25,000 and we're in fact 300 points above there already at the moment. So another substantial push high in US equity markets, and consequently that's seen the other indices follow suit. You can see here this was on Friday, so really irrespective of the move that you had on payrolls, so in the wake of payrolls this was kind of the price activity, and you can see later on in that session with nothing really new, concrete headlines hitting the wires, we just continue to power higher. This comes, of course, irrespective of a lot of people over the last week questioning the sanity of US President Donald Trump. He's made quite a few comments after this book being released, The Fire and Fury, looking about what Trump is actually like and how he's running his administration. But really, I think these types of stories seem to be just bedded into people's expectations now. They expect nothing else but what they're hearing about Donald Trump and the series of tweets that he fired off at the weekend. Things about his big red button being more red and bigger than yours. These sorts of things are completely unsurprising now, as ridiculous as they might seem when you read them on first glance. So it hasn't really translated into anything from a market point of view, and if anything, this equity push, a lot of it still is on the coattails, of course, of the tax plan that he managed to push through by the end of last year. And obviously people are looking for the next phase now, and where does he go from here, whether that's infrastructure spending, whether that's further pushes towards deregulation of the market. One would think that will probably come towards the latter part of Q1, given that Jerome Powell, who's a little bit more let's say friendly on the idea of loosening of financial regulation, he's due to take over from Janet Yellen, of course, at the beginning of February. So still obviously to be monitored, the Trump situation. We'll have a bit of a talk about him in more detail shortly. But looking at the charts then this morning, the DAX gapping up here, centre left chart, only mildly, but breaking that fairly that topside level, which was his respective R2 on Friday session. It really failed to break that until the close, and we had that final little squeeze up in the US indices on Friday. But we've gapped up, found some resistance at R1 to start the session, but the European indices following in suit and trading higher at the moment. Remember, the Nikkei was closed last night. Now, one of the things here, when you're looking at the kind of shape of the week, if you like, is that Asian markets start their corporate earnings season this week. We're going to get quite a few of the bigger Asian names come out to report, and most analysts on the street generally are quite upbeat about the outlook and corporate profitability going forward. So another reason why these equities have been underpinned to the upside. So something to just bear in mind. Elsewhere, if you're looking at the the currency charts, which are on the top left-hand corner, you can see my euro dollar and cable charts. Both are trading to the downside. Now, one thing was the euro last week. I was actually away last week, not looking at the markets too intensely, but as I understand, we got off to a pretty good start for euro dollar in terms of upside movement to really kick off 2018. But you can see we've already paired that loss, and this morning we've taken out quite a key technical level around that S1 of 120.55. That would have been around the support point that was seen from kind of mid last week. You can see there on 120 kind of 50-54 level. So a break of that, technically just seeing a bit of a pullback here in the euro dollar pair, but predominantly on the back of some dollar strength more than anything. Cable as well, trending lower. It's had a test already on S1. I guess in near-term levels of significance, we'll just be looking at that low point that we're seeing back on Friday morning before the bounce. Beyond there, down at S2, which would be close to that initial fall that we printed back on that same low point and that technical level in euro dollar. In cable, that's around that 135.25. Now, there are a couple of things to just have a look at when it comes to the sterling currency. From a news perspective, you might have read over the weekend, emanated from the Times newspaper, Theresa May, stronger May finally ready for UK cabinet reshuffle. So Theresa May bid farewell to 2017 by firing, of course, her deputy and starting the new year with a cabinet reshuffle, a sign the Prime Minister is intent on seeing Brexit to completion and fighting another election. So this is something to just keep an eye out for. From what I've read, though, the actual kind of composition of the Brexit team will remain largely unchanged. If David Davis were to go, let's say hypothetically, that might create a little bit of near-term uncertainty, and generally speaking that tends to translate into sterling negativity if that were to materialise, given who would be his replacement and so on and so forth. But the cabinet reshuffles, this is more politics. I don't think it's going to really translate too much into a tradable market event, unless something unexpected, a senior member was to be ousted or someone put into a more senior role to do with the Brexit situation. Looking at the economy, though, this is probably fairly unsurprising, and this is why I don't think it's really had much of a market impact, but it certainly fits with the ongoing narrative for the UK consumer, and that is that the UK consumer pullback sees the worst year for spending since 2012. I've just seen Mothercare this morning down 25%. My wife is currently pregnant, so I think I'm probably the only one propping up Mothercare shares at the moment through physical purchases. But yeah, retailers have really had a tough Christmas period overall. Looking at the UK consumer, then, they've curbed spending for the first time in 5 years. This, of course, comes amid those two ongoing themes that really defines the second half of 2017. This is really the fact that wages are seeing lackluster to any growth amid inflation remaining at multi-year high levels. So UK Visa, they do basically a constant tracking number, and they've said that their figure had slipped 0.3% last year from 2016. It also fell on an annual 1% in December over the crucial Christmas period. So this is where we were looking at here. This is consumer spending on a year-on-year change. The axis here going through 2015, 16, 2017 to where we are at the moment. Kind of the worst level since the summer, I guess, of 2013, as household purchasing power has continued to be eroded at the moment. The one thing, if you continue to scroll down here, and this is really the bigger play for the sterling currency. You might have seen me share on our Facebook community page. Well, let me just bring that up actually, and we can have a look. There was a call from analysts at ING, and they were looking at where is cable going to go this year. Let me see if I can quickly pull it up. Here it is. So this was looking at cable and where we're trading at the moment, so we've got a rough 135 handle. The median call is then by year end, we're going to be pretty much exactly where we are at the moment. Of course, there'll be a fluctuation in price activity, but generally speaking, stuck within a mid 135 price point. Now, ING, on the other hand, you can see here the green line, they are way more optimistic about the forecast for sterling going forward, and a predominant amount of this is down to the thinking that a transitional deal will be secured and then business confidence will return, and net therefore so will consumer confidence to spend, and so on and so forth. And if corporates have more confidence, they're more willing to pay people more, employ more people, so on and so forth. So bucking the street though is ING on that outlook. But a lot of this is dependent, and if you look at the schedule of the Brexit discussions, it's going to hinge on the end of Q1, because in March we have the next big EU summit, and by that time, March just so happens to be the time of which when most of the large corporations that are based in the UK have said, if we haven't really secured a transitional deal and have clarity over the near-term future, it is at that point we'll start to action plans to move geographically our locations out of the UK and then potentially into mainland Europe. So the next 3 months are really pivotal for the outcome of Brexit and therefore the net direction of cable over the foreseeable future. And so I'd say the bigger moves are likely to come, I would have it a guess, towards the closer we get to that March EU summit. So coming towards the end of February, the beginning of March, that's when you're starting to see that kind of return to headline reaction, UK national newspaper sources, breaking news, much like we were seeing before when they were trying to find this divorce settlement fee agreement at that time. So looking at this graphic though, quite interested to see then the effects of Brexit is really what's the biggest concern ongoing for UK CFOs at the moment. And there's a net reaction of that, weak demand in the UK, poor productivity, or weak competitiveness, and so on and so forth. So concerns of bubbles in the financial assets and housing market, prospects of further rate increases are lower down the pecking order to the bigger elephant in the room, which is what is the outcome of Brexit. So a bit more longer time frame, obviously, these discussions, but worth talking about given the context we're getting the year underway at the moment. Okay, let's have a look at oil. Now, let me just show you the chart to start with, because, oh, excuse me, just accidentally shut that chart. Let me just reopen. 1 second. So this was WTI. To get the year underway, we've rallied from pretty much a $60 handle. And you can see here, towards the latter part of last week, we managed to breach $62. Actually, it was the strongest opening week for crude in any year since 2013. So we continue to, well, if you look back to mid-December, we've risen from basically 57 up to 62, so a decent $5 move, a multi-year high. So one thing I wanted to look at firstly was we had the rig count from Baker Hughes, as we always do on the Friday evening, and working rigs drilling for crude fell by 5, and the 7 days ended to the week of Jan 5th to 742. I think that was the first decrease we've had in a couple of weeks. So that certainly fits the story then in regards to the supply side, if they're starting to decrease rig counts on the US perspective. Ongoing as well, probably the biggest driver here is about what's driving the equity markets. It's the same situation for the crude market. It's this ongoing improvement of global economic growth expectations and performance that's continued to drive the demand side back up which had been fairly lackluster in an oversupplied glut market that we've had in crude oil, you've got a distinct rebalancing going on at the moment, where demand is continuing to pick up and those expectations, whereas surplus of oversupply of crude is starting to diminish at this point. This, of course, under the backdrop of OPEC, non-OPEC nations remaining committed to their pledge to keep control of prices by maintaining those substantial cuts of just shy of 2 million barrels per day as well. So a lot going on with oil helping prop up this market, but obviously a lot of positive sentiment to kick off the year thus far. But a little bit taken off the table this morning. We've come back to flat, having traded higher in overnight trades, so we are sub-pivot level at the moment. Probably the first interesting levels of significance, should we continue lower, will be down at that 61.11, which was around the volatility price point low when non-farms was released, which was just above the 61 handle, and then below there looking at kind of the resistance points that kicked off 2018 as well. So that's really the crude story. Okay, so just want to have a look at the week ahead. Starting off with today's session, obviously we've got a group of the trainees transitioning over from trading on the sim to trading live for the first time. So as I always point out on this day, just you've had a bit of a break, of course, so no need to feel a rush to get immediately back into the market. If you feel more comfortable, just take your time, get a bit of a feel back for how markets are reacting, so on and so forth, and then start to just take your time, use some smaller size possibly, unless that a clear-cut opportunity arises, just to get that feeling of trading live for the first time for those that haven't done so before. Otherwise, looking at the calendar, it is pretty quiet today. There's not a great deal. We'll look at the weekly calendar in a second. When it comes to 10 o'clock, you've got Eurozone retail sales, you've got the various sentiment indicators, economic, industrial, services and consumer. These might sound interesting, but typically they're non-market moving. Then you've got, in the afternoon, a pretty quiet US session, employment trends, consumer credit. It's more going to be based upon Fed speak than anything else. But that's not coming really until London time, the afternoon. So you've got Fed's Bostic, Fed's Williams, Fed's Rosengren. They're all going to be speaking, and two of them, the latter two, talking on inflation specifically. So that, of course, could be quite interesting. This is still the main focal point for federal policy at the moment, or federal monetary policy. Looking at the week as a whole, Tuesday, Japan returns to the market. As I said, they had a market holiday overnight, so they were shut. But you get their consumer confidence overnight. German trade balance to kick things off. Just so you're aware, we have had some German data this morning. You had German factory orders, but these were, even though weaker than expected at -0.4 against expected +0.1, I wouldn't say this is having too much of a net impact. I guess the euro is a little softer, but this is more byproduct of dollar strength, with the Dixie reclaiming 92, which is up just over 0.25%. In regards to the dollar index. Tuesday, you do have one thing, and this is something which Donald Trump has claimed it was down to him, but North and South Korea delegates, they meet for the first time since 2015. That's happening on Tuesday. This, of course, is quite interesting, just given the context of, I guess it was more Q3 of 2017 was quite a prevalent theme, and this is the first time that they've engaged in talks in a couple of years. So it'd be very interesting to just monitor that situation to see the outcome. I would say, though, that North Korea going into this year has dropped down the pecking order as a potential market risk. It, of course, remains one, but I'd say that that's definitely become a less of a priority in terms of the possibility of escalation, I'd say, to factor in as a risk. Going into Wednesday's session, you get some Chinese inflation data, could be interesting to track from overnight, from the UK trade balance, manufacturing industrial production, you get your weekly oil inventory numbers from the DOE. Thursday, you've got US core PPI numbers, and the PPIs and ECB minutes. So this then leads us in from a US perspective to probably what is the main release of the week, which is going to be on Friday, and that is US inflation data, which comes accompanied by retail sales from the States as well. So I guess from an economic release point of view, it's really Friday which carries the most important data set. So pretty quiet overall actually for a week. The interesting things of course will be with equities remaining at these very elevated levels. What you'll probably see is that volumes will start to pick up as of today from what you probably saw last week, because a lot of people often take off that first week. So this would be the first time you would expect all market participants to be back in fully to the market now. And at these elevated levels, you'll be interested to see, do we see a little bit of profit taking, or do we just come back down a little lower for the next buy the dip, excuse me. A lot of talk on Bloomberg that I'm hearing this morning is about FOMO, and coming in this morning, and well, hopefully Sam can share some of his trades, because he was pretty much long Dow, I think, for all of last week, which worked out very nicely. But the key will be, and the interesting thing I'd be to ask someone like Sam, who was long Dow all last week and obviously a fantastic trade, what about now? How do you feel about now? Are you taking some out, or are you still keeping some on, thinking that we're going to have another squeeze to the upside? So hopefully these are some discussions we can have in the chat room later on today. Okay guys, going to leave it at that, let you guys get on, get your head back in the game. Welcome back, Happy New Year, and have a good day. Thank you.